Your guaranteed savings accounts are quietly destroying your purchasing power. If you think locking your money away in government bonds keeps it perfectly safe, you are actively participating in a slow, invisible wealth drain. You're bleeding cash, and you don't even see it happening. In this explainer, we're tearing down this massive illusion of financial safety.
So, I want you to answer a really hard question honestly for a second. Is your safe money actually disappearing? Because look, while you might not literally see the balance drop on your monthly bank statement, inflation and the constant erosion of the dollar are secretly draining your wealth. Every single year you sit entirely on the sidelines, it's just vanishing.
Okay, let's dive right into this. To actually understand this silent wealth drain, we have to look at the data presented by Benjamin Graham. You know, the guy widely considered the godfather of value investing. For decades, common stocks were viewed as highly speculative, like incredibly dangerous, while bonds were the absolute gold standard of safety. But Graham's analysis flipped this entirely upside down. He proved that bonds offered absolutely zero protection against the erosion of the investor's dollar caused by inflation. Stocks, surprisingly enough, became the ultimate shield.
Let's actually look at the numbers here. Take a snapshot of a 20-year period right before 1949. Now, at first glance, bonds seem to be the clear winner, right? A $10,000 investment in long-term treasury bonds grew to over $21,000, hitting a 3.9% return, completely beating out common stocks. But wait, this specific period was a total trap for the casual observer, because what followed was a massive awakening. Stocks eventually became the only real protection against constant inflation, and over the next decade, the stock index gained an average of 20.1% per year. The people holding only bonds, they were left totally exposed to the brutal loss of their purchasing power.
But hey, before you go throwing all your money into the hottest, fastest growing companies out there, we really need to talk about what happens when the emotional herd chases massive returns. Because if holding only bonds is a slow bleed, buying into the growth stock trap, that is a catastrophic amputation of your wealth.
Take the historical scenario of Texas Instruments. Over a 6-year period, their stock price absolutely skyrocketed from 5 to 256. I mean, the price advanced 5 times faster than their actual profits. This is literally the classic symptom of a popular growth stock. The emotional herd buys in at wildly excessive prices. And what happened just 2 years later? Earnings dropped by nearly 50% and the stock price utterly collapsed by 4/5.
And you know, this isn't just some isolated incident from decades ago. Think about Cisco between the years 2000 and 2002. After rising roughly 50-fold over the previous 6 years, the stock lost 76% of its value. 76%! As Graham's data so clearly shows, the hotter they are, the harder they fall. Even the most popular, revolutionary companies out there will inflict devastating losses on your portfolio if you pay an excessively high price for them.
So if bonds bleed you dry through inflation, and growth stocks can wipe you out literally overnight, what do the absolute elite investors actually do? How do you survive these massive market crashes and build real, durable wealth? Well, you follow the defensive investor blueprint. This is the insider strategy used by the 1% to completely bypass those emotional market swings.
The absolutely crucial point here comes down to 4 unbreakable rules. First, adequate diversification, meaning you want to hold a minimum of 10 and a maximum of about 30 different issues. Second, only buy large, conservatively financed companies. Third, insist on a long record of continuous dividend payments, at least 10 years, but ideally way more. And finally, impose a strict limit on the price you pay relative to earnings. Specifically, a price-to-earnings ratio of no more than 25 times the average earnings over the past 7 years. Boring? Yeah, maybe a little. But this blueprint, it acts as an impenetrable shield for your money.
And just to remove any ambiguity here, because this is super important, let's define exactly what a conservatively financed large company actually looks like. It means a primary company with at least $50 million in assets, ranking in the top third of its industry. Crucially, the common stock must represent at least half of the total capitalization, and yes, that includes all bank debt. Applying this strict criteria instantly cuts through 90% of the market noise, keeping you way out of dangerous, over-leveraged territory.
Now, how you actually apply this blueprint depends entirely on who you are. Graham's data profiles 3 specific situations. A widow with $200,000 nest egg needs strict conservatism, so a 50-50 split between stocks and bonds is the perfect defensive compromise. Then you have a prosperous doctor with $100,000 who might think he can beat the market. But lacking the time for real professional study, he's notoriously likely to fail unless he sticks to that exact same defensive approach. And the young saver? Look, don't try to beat the market. Start small, buy into this defensive program, and just gain the right temperament. Your strategy should always be based on your financial equipment, meaning your actual knowledge and experience, not just the size of your bank balance.
Which brings us to perhaps the most powerful, stress-free wealth-building mechanism ever analyzed. Honestly, I like to think of this as an automated arbitrage loophole. It's technically called dollar cost averaging, and it is absolutely the ultimate way to completely remove dangerous emotional buying from your financial life.
Let's see how this actually builds your wealth over time, because this is where the math just gets incredible. A comprehensive study by Lucille Tomlinson tested dollar cost averaging, which, by the way, is just investing the exact same dollar amount every single month, no matter what the market is doing. They tested this across 23 10-year purchase periods. They started in 1929, right before the worst market crash in history, went all the way through the Great Depression and World War II, and ended in 1952.
So, the result? Every single test showed a profit either at the close of the purchase period or within 5 years after. And the average indicated profit at the end of these 23 brutal, historically volatile buying periods was an astonishing 21.5%. And here is the absolute kicker. That massive profit metric completely excludes the dividends received. By simply automating your investing, regardless of what terrifying things security prices are doing, ultimate success is virtually engineered right into the math. But to truly utilize these strategies, you have to completely reframe your paradigm around a single word: risk. Ask anyone on the street, and they'll tell you stocks are risky because the prices constantly go up and down. But inside the elite investing club, that is not what risk means at all. True risk is definitely not temporary price fluctuation. If a group of well-selected common stocks shows a satisfactory return over a fair number of years, it's safe, even if the market value fluctuates below your cost for a little while. True risk is a loss of value realized through an actual forced sale, a significant deterioration in the underlying business, or, and this is by far the most common one, paying an excessively high price for a stock. Cyclical price drops are just an illusion. Permanent loss of capital, that is your real enemy.
And this brilliantly illustrates the final, absolutely most powerful piece of the wealth-building puzzle. Remember earlier when we mentioned that those massive dollar cost averaging profits didn't even include dividends? Well, let's look at exactly what happens when you unleash the full force of those dividends over time.
I really want you to burn this staggering outcome into your mind. According to a study covering the entire 20th century, if you invested just one single dollar in US stocks in 1900 and spent all your dividends, your portfolio grew to $198, which, hey, isn't bad. But if you reinvested those dividends, that exact same single dollar turned into $16,797. No way, right? Far from being just some afterthought, reinvested dividends are the greatest force in stock investing. It is the real glitch to mastering your money through compound interest. So I'm going to leave you with this. Knowing what you know now about the silent drain of inflation, the growth stock trap, and the unmatched power of reinvested dividends, are you actually investing defensively, or are you just waiting to be a victim of the herd?